Hey guys, it's Chris Mincolla with the Mincolla Group over at West USA Realty, and I'm doing our housing weekly market update for the greater Phoenix area. And we'll get into some national news. We got a CPI report on inflation, which of course affects our 10-year treasury, which affects our mortgage rates, and some other news that I'll share with you with everything going on in the headline. So let's jump right in. And I'm going to share my screen here with you and tell you what's going on. Okay. So, on the energy front for the global markets, now we only get like basically nothing from Iran as far as oil is concerned, but it's affecting the global markets, which of course affects um, the oil costs. And then we saw that they went up. I think it was about 110, 120 dollars a barrel, and then they had like the biggest day drop. I think they ended up around 80 bucks a barrel right now. Normally, that hovers between the mid 60s, the low 70s for the past several months. They usually like to be above 50 bucks a barrel, so they're making money on the oil. But Trump will decide whether U.S. participates in IEA release of oil reserves, Interior Secretary says. Um, and this would drain more of our oil reserves. And then President Trump says he'll fill it right back up when prices come down. He says they may come down even more lower than they were before once this is over with. I think the biggest thing with this is if this thing is over, let's say in a total of, since it started, let's say it's over within 3 to 6 weeks, I think we're good. If we go into, past a couple of months into 3 months, this could cause some more volatility in the markets, which will affect mortgage rates. So we'll see how that all plays out. But later on Wednesday, it says here, President Trump said later Wednesday that he will tap the Strategic Petroleum Reserve to help lower energy costs. So that'll be a short term fix to get through this period. And we'll see. Maybe they'll throw even some more money into those mortgage-backed securities. They already did 200 billion. I think they did that before the whole Venezuela thing. Then we had the Venezuela thing. We should be getting some oil from there going a little bit more. I think they were talking about that also. So that should help offset some of this volatility for us. But it does affect the global markets, which affects the bond market and the volatility there. So that's why we're seeing some of the headlines we're seeing right now with mortgage rates. And also our CPI, Consumer Price Index for inflation, rose 2.4% annually, which is what was expected. The markets like it when things happen as expected. So um, that isn't necessarily an issue. And, we always get into a discussion about, inflation. And I'm going to show you in a minute here. Inflation has come way down, but I mean, we were up at like 9, 10% inflation at one point under the last administration, and it's come way down. But here's the thing, again, that I mentioned before, and that is that, people think that when we talk about inflation, that it's, we're going to see the price of everything come down. It's not that, it's that the rate of inflation is coming down. In other words, it's not going up as much as it was before, especially when they look at the readings year over year, month over month, what that looks like. So we're at a whole new price level because of all the spending that was done that continued into 2022 with printing that extra $2.3 trillion, which really wasn't needed because of the whole COVID thing was kind of over, and that was why they did that. It was supposed to reduce inflation. Later on, they admitted it actually increased inflation. Jerome Powell came out and said, "Yeah, we did print all that money. Yeah, you did, and it increased inflation, increased interest rates, and flipped everything on its head." So it's just getting it to where our incomes are rising, above where, with the GDP up. We've certainly seen that, but keeping it above that inflation rate. And This whole 2% target thing, I think it should be more of a range, like 2.5 to 3.5, in my opinion. And a lot of economists have been talking about that for a while. Also, the way that they gauge all this, which I'll show you more in a minute on how they actually calculate in their models for inflation, because actually the historical average on inflation is like 3.5, 3.8, somewhere in there. It's well over three for the historic average on inflation. Okay. So this whole 2% target, not saying we want to have higher inflation, but what I'm saying is that whole 2% target that originated an idea from, or is it, uh, not Switzerland, I forget, New Zealand. It came out of New Zealand, this 2% target thing. And I think that that's really kind of, especially in the modern world with higher GDP, rising salaries and things like that that we're seeing now. I think, I think we're going to see some models change there. Let's just put it that way. You wait and see. I think we're going to see some models change there. But I think we're also going to see this inflation to continue to tame once some of this volatility is over. But anyway, the core CPI posted at 0.2% monthly reading. And so, everything adjusted, we are at zero point 0.3 for the month, putting a 12-month inflation rate at 2.4%. So we also know that the Fed looks at more at PCE. We should be getting that at the end of the week on Friday. Also, the Fed meets next week on the 17th and 18th. Um, Expect no rate cut from them right now while Jerome Powell's in there. For the time he's in there until May, as Fed chairman, you're not going to see any rate cuts from them. But I think we're going to see this volatility end sooner rather than later. That's the hope anyway. But when you look at this inflation, um, and you look at the 12-month percentage change and consumer price index, these are kind of all items, food items, energy, and all items less food and energy. And you can kind of see where that's at. And then when you look at this overall, you can see that inflation is definitely coming down. But here's the big one, guys. Here's the big one that we talk about a lot. I wanted to show you this chart. Look at that. From going from the highest point, which was in 2023, um, this is the shelter costs. Okay. The way they calculate this is it's a survey that's done that goes back to the 1980s. Okay. Now, they call people up and they ask you how much you think your home will rent for. That's how they calculate this. Now, I don't know about you, but that seems very antiquated to me, especially when we have real-time data to look at. Okay. And one of those real-time data sources that we have that a lot of economists talk about is Trueflation. And right now, their CPI, and this basically comes in at a lot of different data points than even what the BLS and the Fed track. But this comes in right now today at 1.08%. 1.08% in real-time true data, because the BLS, the Fed, they're looking at old data. Okay. They're just starting to get caught up on this shelter data. Okay. And this shelter data makes up a little over a third of the inflation reading. Okay. A little over a third of that inflation reading, the rate of inflation. So you can see the slope here. Okay. So that tells us a lot. Okay. That tells us that they're way behind. Trueflation is definitely, and you can look at their track record, go on the website, go on their X handle. You can see their track record is right in line. They're way ahead in real time data and looking at the older data. Jerome Powell, they're looking literally a couple years back in their rearview mirror. So when they're looking at this, they're looking at like right around here. Okay. Not all the way down here, which would basically cut that just about in half. So, I was listening to an economist today again saying we should be about 100 basis points lower on the Fed fund rate, which doesn't directly affect the mortgage rate, but they've been moderate to hawkish, depending on which fair Fed person you're talking to. Um, and they also want to say their other mandate besides inflation, and we talked about this last week, is the jobs reports. And the jobs reports, they showed, right around 4.3. It's been hovering right around 4.3, 4.4 percent unemployment. And then, until we see 300 and probably 323,000, a report of 323,000 in the current models they're using, we're not going to see that labor over inflation for what they're looking at. We're not going to see that move the needle for them. But the jobs report was horrible. It was, the two biggest sectors that you need to be watching are the manufacturing, which is going to ramp up, but it's going to take another year or two to see the fruits of that money coming in. Maybe longer, 3 or 4 years. The construction jobs taking a hit again in the last report that I showed you last week. Um, so those are indicators, and the job starts are just terrible, and the numbers got revised down over the last 2 or 3 months. So all that being said, the Fed is behind along with this. Okay, along with this, they are behind, and we want to know why there aren't more job starts and why the economy is not taking off more. It's because the Fed rate is too high because companies need capital in order to operate. That's just how it works. Okay. Some overall things here that I wanted to show you. I'm going to bring this over and really quick. So the CPI, this is from Logan Mohtashami. CPI over at Housing Wire suggests, it's easing but not fully beaten according to the models that the Fed's using and the BLS. Existing home sales, which rose 1.7% in February to a 4.09 million annual pace, even though they're still down 1.4% from a year ago. On demand, mortgage applications increased 3.2% for the week, while the purchase index jumped 7.8%, pointing to improving buyer activity heading into spring. And year over year, we're up 11% on the mortgage application data total. So again, that mortgage application gives us a window into the next 30 to 90 days. That's a good indicator. It's been up every week this year on application data, while the purchase index is up. Okay. So that's good going into the spring market. I would get ahead of that, guys. If you're thinking about selling or buying, I would get ahead of all that competition. Okay. Overall takeaway, inflation was tame enough to help rates stay in a workable range. Resale activity showed some life, and buyer demand is picking up. This looks like a steadier, more active spring housing setup. Mortgage rates dropped again. They're actually up today, which I'll get to. But a lot of this has to do with the conflict in the Middle East. Bond market doesn't like that stuff. Okay, uncertainty and volatility. We're just going to see that till this thing's over with. Uh, Despite global uncertainty, we also had 3 ships that were hit, according to reports. I don't know. We got to confirm that. Um, but housing conditions remain stable with rates near 6%. Um, yeah, I think today, well, I'll get into it in a minute where exactly they are and where you can get lower rates right now. But they're hovering right around that 6% mark, up or down a little bit. Recent existing home sales data beat expectations, but analysts caution that winter and holiday distortions make month-to-month numbers unreliable because of all the winter storms. Now, in the Northeast, you have very, very low inventory. I think it's like in Connecticut, it's like a 1.5 month supply compared to, the South or the West. Recent existing home sales data oh, wait, I just read that. The housing market is shifting to a healthier balance. Inventory is higher, which gives us some cushion there. So we're not, things aren't, going back into a 2021 type scenario. Price growth is cooling. Buyers have more choice. The biggest economic risk right now is the energy supply disruption from the conflict, which could impact inflation and a broader economic if it drags on. Again, it's not that we're not getting oil from Iran, because we really basically get just about nothing from there. It's like maybe 3%. But it's affecting the global markets, which affects our market. The upcoming Fed meeting is expected to result in no change in rates, but we'll monitor the inflation and jobs numbers and geopolitical events. Now, just a real quick thing on this trueflation, just so you can understand. Again, and the shelter data, we have like companies now with, not only real-time data with the internet, compared to what they were doing in the 1980s that they're still doing today, which is absolutely insane. With this owner's equivalent rent survey that they do, which is nonsense. But on top of that, it shows that slope you saw earlier with the shelter costs coming down, even with that. And, we have here with the official core CPI coming in where it was. Today's trueflation, it says CPI is 1.08%, below the 2% target since December 2025. Today's trueflation core CPI is 1.06. Our data team uses trueflation data to correctly predict the official CPI numbers. However, our index differs from the BLS index, despite both being year-over-year CPI rates. Trueflation says purposely introduce multiple improvements to the traditional BLS methods, such as more accurate and up-to-date weighting from 2025 instead of 2024. In other words, not going back 2 years, but looking at where we are in the more recent data. Different subcategory distribution, more current and price-based rental index and homeowners cost. In other words, real-time data from real-time sources like MLSs, Zillow, which those MLSs all syndicate to. And we can pull all this now also and read it in real time, especially with the advent of AI. This is not kind of we need 1 million people running this data. Usage of high quality data providers and real price transaction data, which we assess and test frequently and meticulously. So I'm going with that. I'm going with the new real-time data. And even with that, guys, we're way down on this shelter. So across the country, like we said, mortgage applications are up. Single family inventory is up. We have inventory growth at 6.91%. Okay. And we see that reading is up over last year on the mortgage applications. That gives us an indicator on supply, demand, jobless claims, which we talked about last week. I'm not really going to get into that. We could see new listings is up for 2026. Percentage of properties with recent price reductions for 2026, we're at 32.7%. Kind of a normal market, guys. It's really kind of a normal market. Total pending sales is up year over year. Okay, nothing crazy, but we're going to see more sales the way things are going than we did last year. So, we'll probably see, instead of 4 million, we're going to see more, more in the range of something like probably 4.25, 4,250,000 to 4,500,000 total sales for the year across the country. The spreads between the 10-year Treasury and the 30-year, much better this year. Okay. Recently had a little bit of an uptick with everything going on, but even with all these crazy headlines, we're doing good. Here's where we ended up today. For the last 5 days, we can see the 10-year Treasury went up, which means our mortgage rates went up. And where do we end up here on the 30-year fix today? At 6.24. So with our local mortgage broker, you can get ARMs right now in the low fours. 5-year ARMs in the low fours. Okay. That's for FHA, VA, and then for your conventional, you're going to be somewhere in the low to mid fives on that. And then with the fixed rates, with our mortgage broker, usually they're going to be about 100 basis points better. It all comes down to the pricing. It all comes down to the fees that are structured, and they're just charging you less. So why not save that money? And of course, if you want to look at new builds, there are pretty much all of them, especially here in the Phoenix area. They are offering all kinds of incentives, paying closing costs and/or offering you lower bought down rates. Into I've seen them as low as 1.99. For 3-2-1 or 2-1 buy down rates for the first 2 or 3 years. Fixed rates are usually going to be out of the box, usually going to be in the threes or fours with a new home build right now. So if you have any questions on that, let me know. We can definitely get you access to off market properties. We know where they're at. We can pull them quickly for you. But so right now, the fixed year through our mortgage broker is going to be more like in the low fives. Okay. I didn't pull those rate sheets today, but if we look at the overall data for the greater Phoenix area, this came out on Monday. 79 days closed on market. We're at 5.65 months supply. Absorption rate 17.70%. We're at an average list price of 787,000. Average sales price 687,000. List to sales price ratio, we're coming in right at 96.9. But I'll show you something here in a minute on that actually just in the last couple of days ticked up a little bit. So, but according to this, sellers are giving up just over 3%. Actives are up 0.7%. And then your pendings are up week to week 4.8%. So there's more buyers jumping into the market. Closed units is down, but we're going to see this catch up with this. Okay. The pending sales catch up with that. And we're actually seeing that our lender owned REOs, short sales, it's a non-starter, non-issue, guys. So when we look at the different price ranges, we've got 66.35% from 0 on up to 600,000. 600,000 to $1 million is 18.86%, and $1 million plus is 14.78%. All right. So now if we look at this dashboard here in our rapid stats from the MLS here in the Phoenix area, we can see that year over year, our listing count is actually up 18,582 for over the last year. It's up 1.3% over last year. Listing count sold is up 4.03%. Okay, so those other numbers were week over week. This is year over year. So our solds are up and our under contracts up 13.53%, guys. So this means you've got more buyers getting into the market than you did last year. What's actually sold and what's going under contract. So this gives us into a window into the next 30 to 90 days for getting through escrow periods. And then if we drop down here to the sold to list price ratio, we can actually see that this is as of midnight from the last day. Our median sold to list price ratio has actually gone up in the last couple of days to 98.77% for the median, and the average is 97.9%. So sellers actually giving up a little less in the last couple of days since those other numbers were taken into last week. So looking at the MLS right now for all property types, we've got just over 25,000 homes for sale. If we look at just single family, we're at 18,354. And jumping right into the Cromford Market Index, Below 90 is a buyer's market. Above 110 is a seller's market. Right now, coming in at 82.8. So being totally at a neutral market would be 100 or 90 to 110 in a neutral range. So we are in a buyer's market right now. Now, every little subdivision, every little zip code and area is going to be different throughout the valley. We're still seeing multiple offers on, anecdotally on our properties. Depends on the area. But if we look at, for instance, we had a couple listings in Sun City, Gilbert, Glendale, where we saw this, multiple offer situation, as well as Peoria. And we right now our supply is just over 100 at 103. So the supply is fine. We just need a little bit more demand to get us into more of a balanced market. So right now that's 14 points lower than 100. And that tells a story on that. Now, if we want to look at more of what's actually happening at the moment, this is our contract ratio chart. Right now we're at 37.5. Last week we were at 36.4. Okay, so that's going up. The number of homes that are active compared to the number of homes that are actually under contract right now, that's going up. Right now we're in a warm market according to this in real time, even more than that last dial chart. Okay, so we're kind of in a warm range. And if we look at the heat map right now, if we can get that to jump to the right screen for us, we are actually seeing more hot areas than we were just in the past week when we did our last report. Towards the end of last week, we actually had two reports last week. Go and check those out on YouTube or Facebook. You can catch clips on Instagram and even our TikTok page. But hot, we right now, the hot area is this whole area of Levine, 85339. We've got active 146, under contract 89. That's a really hot area. Chandler, 85286 is a contract ratio of 68. So anything between 60 and 80 is hot. Chandler, 85226 is in a hot area. That's super hot. Wow, that's at 78 there. 78. This one was at 61. And that one over here in Chandler was at 68. That's at 78. Wow. In Chandler right now. Tempe is at 60, just into the hot range. Okay. And then we've got Phoenix, 85029, 65 on the contract ratio. Anything over 60 is hot. And Phoenix 85024 is in a hot area also. And all these other areas are kind of warming up, except for right here in the central part of the valley and out here in the outskirts for Litchfield Park, Glendale. I'm surprised about Glendale. Well, we're actually more over here. So yeah, that makes sense why we're getting multiples there. And then Sun City is showing cooling down. They're in a cold spot right now, along with Surprise. We had multiple offers over there too. That's weird. Okay. Well, anyway, guys, that's what I got for you this week. If you have any questions at all about your property, what we would love to do, even if you're not quite sure if now's the right time to sell, but you're just kind of wondering, that's fine. We will come by, 10 to 15 minute walk through the property, talk about the updates you've done, current condition, okay, and how it presents. And then we will give you an assessment along with the actives, the under contract properties, and the sold properties in your subdivision and area. And then we can talk more about what it would look like, for your home value, and then break that down into a net sheet. So you would know right now, if you were ready to sell, what that might look like and what that range in your home value looks like. And three pricing strategies that we would use to get your property sold, talk about, what we could do to help it present even better, even if it's in great shape. But there are ways to do that so it presents even better. And if you're not quite ready to sell yet, we of course go through our marketing system and all that. But if you're not quite ready to sell yet, that's fine. No obligation at all, no pressure. We just want to keep you get you some good information, leave you with some good info, and keep you updated on what's going on moving forward, knowing what we know and knowing what other improvements you may do down the road. We can add that into the equation, but look at where things are, every month, every quarter, so that moving forward, even if you're 6 months, a year, 2 years out, what that looks like moving forward. So, if you're thinking about making a home purchase, right now, a lot of people are looking at new homes because of all the incentives, price reductions. Some of the things to think about with resales is, you may have property that already has a pool, maybe in a certain location you really want to be in, but there aren't any new homes right around that immediate area. Or you're thinking about an investment property, does it make more sense to do that in town versus on the outskirts? We can talk about that. So feel free to reach out anytime. And we would love to be able to answer all those questions for you. Be sure to like this, share this with some other people that may find it useful, and subscribe to our YouTube, Facebook, follow us there, and our Instagram page. And we would love to be able to keep you updated on what's going on in the market that way too. So feel free to reach out with any questions, guys. That's all I have for you right now. We'll keep you updated on what's going on here in the near future. Thanks.